Hello and good afternoon. It looks like it is noon, so we're going to go ahead and get started with some introductions as more people roll into our Zoom room here. So thanks for joining us for today's Money Counts webinar. Today we are talking all about credit cards. My name is Allie Smith. I am a specialist here at Penn State's Sokolov-Miller Family Financial and Life Skills Center. I head the one-on-one financial coaching program here at the center, and I also host this regular webinar series. Aiden Kamowski is also here with me today. I'll let him introduce himself and say hi here.
Hi, thank you, Allie. Yeah, super excited to be here today. I will be the student ambassador. I have worked for the center for a little over 2 years now, and I'm currently a senior studying supply chain management within the business college. And today I will be monitoring the chat for any questions or concerns that anyone may have. Please feel free to drop those in there, as long as some other helpful links related back to what Allie is saying. But yeah, super excited to be here today. Thanks, Allie.
Awesome. Thank you, Aiden. So Aiden is one of our financial literacy ambassadors, and they do a lot of great work for us here at the center. We're really happy to have them. If you've got any questions, feel free to drop those in the chat, like Aiden said. We'll take a look at the Q&A at the end of today's webinar if you throw any questions in there. For those of you who are attending from the SMEAL Ethical Leadership Challenge, we do have a QR code for you, and we'll post that at the end of the webinar so you can get credit for that. So again, today our topic is credit cards. A credit card can be a great financial tool, but they also come with great responsibility. In today's webinar, we're going to explore how credit cards work, how to manage them responsibly, and how you might get your first if you don't have one yet. So before we dive in here, I would love to know who's in our audience today and kind of how we feel about credit cards. So I'm going to launch a poll out to you all here. I'd love to know what's your affiliation with Penn State, how many credit cards you have, if any, and generally how you feel about credit cards. And rest assured, if any of these questions feel kind of personal, the answers are anonymous, so don't worry. Okay, it looks like most of us have participated at this point. So it looks like we have got actually, we have a great mix in the audience today. Some undergraduate students, graduate students, some staff and faculty, and even some Penn State parents, which I absolutely love. I saw in our attendee list, it looks like Penn State York is also here. So welcome. Welcome, everyone. I'm so glad to see you here. In terms of how many credit cards we have, a lot of us just have one credit card. Some have 0 and some have 3 to 5. So a good mix there. And generally, most of us use our credit cards selectively for specific purposes, which I think is a good way to use a credit card. Okay. Well, again, welcome. Thank you for being here. I hope everyone in the audience gets some value out of today's webinar and walks away feeling a little bit more confident in managing those credit cards, or if you're someone who doesn't have a credit card yet and is thinking about it, with some good steps on first, if you should do that, if it's a good idea, and where to go from here. Before we dive into the nitty-gritty details of credit cards, I think it's important to talk about the pros and cons of credit cards in general. When most of us think about getting a first credit card, typically we want to do so to build our credit score. And this is definitely a perk of having and using a credit card is building your credit score. Spending on a credit card can also provide a sense of security, as credit card companies are likely to be more proactive in dealing with fraudulent charges or fraudulent spending than maybe your bank would be. And a credit card, of course, also makes online shopping possible, but you can also online shop just fine with your debit card, right? Along with building credit, another one of the most popular reasons that I often hear people talk about when they talk about wanting to get a credit card is for the perks and rewards. For example, travel cards can give you free airline miles, and cashback cards can give you cash rewards on certain purchases or on all purchases. And of course, using a credit card instead of cash would make it easier to track your spending for budgeting purposes. Now let's talk about the cons of credit cards. The worst thing about credit cards is that they give you the ability to spend more money than you have, which can be a really dangerous thing. Some people can handle this and can use credit cards responsibly, but some people tend to have a lot of trouble with this aspect of credit cards. Credit cards can also have fees and interest, and we'll talk later about exactly when interest is accrued and how to avoid accruing interest as a responsible credit card user. Also, a credit card, if you don't use it responsibly or correctly, could end up actually hurting your credit score, which would be a bad thing, right? If you open it up to build your credit score and you don't use it correctly or responsibly and it ends up hurting your credit score, it's not really serving its purpose, right? Also, the fine print in your contract or your monthly statement could be confusing and hard to interpret. Credit cards also have age restrictions. The minimum age to be a primary card holder or to open a credit card on your own is 18, but it can actually be kind of tricky to get one before age 21. Student or secured credit cards can make this possible, along with having an independent income of some kind. And we'll talk about that later. You could also be vulnerable to credit card fraud. So let's talk about how these things work. In the most simple sense, after applying and being approved for a credit card, banks or credit card companies provide consumers with credit cards that have borrowing limits. And this borrowing limit is otherwise known as your credit limit. Then consumers can use that credit card however they choose. Consumers can repay the bank the full amount that they spent on the credit card each month, or they can pay a minimum amount plus interest each month. It is important to note that banks do expect to make a profit on credit cards, otherwise they wouldn't exist, right? And a question I get often when I work with folks who are opening up their first credit card is, how do I avoid paying interest on my credit card? And this question can kind of be restated as, how can I avoid paying the bank a profit on my credit card? And the answer is this: pay your credit card bill in full each billing cycle. And the deeper, I mean, that's easier said than done, right? The deeper kind of thing you've got to think about and work on with that is, don't swipe your credit card for anything that you couldn't afford to swipe your debit card for, right? Treating our credit cards like our debit cards in terms of our spending is a good step one in avoiding interest charges. And we're going to dive into and unpack this a little bit more throughout today's webinar, but just know that if you pay your credit card bill in full and on time each month, you will never pay a penny in interest. And that is truly the goal with responsible credit card use. So if you are someone who is thinking of getting a first credit card or maybe even a second credit card, Here are your steps. First, make a plan for responsible use. This is the most important step, in my opinion. Then you'll want to research and compare your options. There are truly a ton of different options out there when it comes to credit cards, and it can be a bit overwhelming. From there, when you've found the one and you're ready to apply, get your information ready, get your docs in a row, and apply. And throughout the next few slides, we're going to really unpack each of these steps in more detail. So step one, our most important step here is to make a plan for responsible use. I shared at the beginning that the reason most of us tend to get a first credit card is to build our credit scores. But if you get a credit card and max it out or miss payments, you'll have the opposite effect on your credit. And you can put yourself in a hole that can be extremely difficult to dig out of. So the most important thing you can do before getting a credit card again is making this plan. I'm going to hit you with some statistics here. According to TransUnion, the average American credit card balance was $5,773 at the beginning of this year, quarter one of 2023. And based on the research that I've seen since then, I do believe that has went up. Also, according to the Fed, the average credit card interest rate was 22.16% in May of this year. And that is not an interest rate that we want to be taking loans out at, right? So if we just look at these statistics, the average American has, according to these stats, a 5,773 credit card balance that is accruing at a rate of 22.16%. That is not healthy, right? That is not a place that we want to find our finances. So only get a credit card if you feel like you can use it responsibly. I always have conversations with students in our one-on-one program who are thinking about getting their first credit card regarding like this responsible use piece. And here's really what it looks like. First, having a budget or creating a budget if you don't have one already. This can help give you a good idea on what you should or can be spending on with your credit card and what you really shouldn't be or can't afford to be spending on with your credit card, and really how much is reasonable for you to spend. I do want to highlight that when you get a first credit card or a credit card at all, you don't have to spend a bunch of money on it to build credit. You could put a small subscription or one transaction on your card each month and pay it off. And this would actually do the same for your credit building as someone who is maybe putting $200 on their credit card a month and paying it off. And if you sign up for auto pay, this could all be happening in the background. So for example, a lot of times I'll coach students through getting their first credit card, and they'll decide to move their Spotify subscription over to their card. Then they'll sign up for auto pay, and this kind of credit building magic is happening in the background with them without them having to think about it too much. Autopay is also a really good tool to help you prevent those missed payments. Payment history is the largest factor that makes up your credit score. So missing a payment could end up really hurting you in your credit score. Fees also come into play when you miss payments most times. And then finally, have a repayment strategy. If you don't set up autopay, you better schedule paying your credit card on your calendar each and every month so you do not forget it, right? So here, this is our plan for responsible use. Create a budget so you won't overspend on your credit card. Consider autopay so you don't miss payments, and have a repayment strategy so that your balance doesn't grow to something larger than what you can pay off in that billing cycle. The next step after you've made this plan is to research and compare your options. These are all terms that you might come across while researching which credit card might be best for you. So there's APR, or annual percentage rate, credit card perks, ease of use, fees, and card types. and we're going to dive into each one of these separately, except for ease of use because it's fairly simple. For ease of use, I would just encourage you to think about what you're really looking for in a credit card, and if it has those features, that will make it easy to use for you. So can the card be used for international travel if that's something that you need? Does it offer auto pay? Is there paperless billing? Is there an app that you can do online banking with? Is there simple customer service? That kind of thing. So let's look further into each of these other ones, starting with credit card type. The most common types of credit cards that we'll cover today are standard credit cards, secured credit cards, charge cards, and student credit cards. When we think of a credit card, we're usually thinking of this standard credit card. These are your Discovers, your Capital Ones, your Chases, your Bank of Americas, etc. There are really a ton of different credit card companies out there. With a standard credit card, you're issued a credit limit after you're approved, and it's really up to you to manage that credit limit responsibly. A secured credit card is a good option for folks with adverse, limited, or even no credit history. Secured credit cards are a special type of credit card that requires a cash deposit, and that cash deposit is usually equal to your credit limit, and that has to be made when you open the account. This money then kind of acts as collateral every time you make a purchase. And this cash deposit that you'd make on the secured credit card, as long as you keep your account in good standing, is fully refundable back to you. Charge cards are less common nowadays. Most financial institutions have phased them out. However, a few banks still do offer these. Charge cards are different than credit cards in that a charge card is a card that requires payment in full each and every month. It doesn't have a preset spending limit like traditional credit cards do. With a charge card, failing to pay off a large balance in the month time frame can definitely be an expensive mistake. You will face a late fee when paying after your due date, which is usually around 2 to 3%. So, for example, a past due payment on something like a $5,000 credit card bill with a charge card will likely cost you at least $150 at minimum. And finally, there are student credit cards. These are credit cards that are specifically for students, as the name would suggest. Student cards typically come with a low credit limit, which is a good thing for students who are getting their first credit card. Otherwise, they function pretty much the same as a standard credit card and can be a good tool to help students build their credit. To obtain a student credit card, most times you'll need to have at least one of the following. So be over 21, have an independent income, so a job of your own, or have a parent or a trusted adult to co-sign on that card. If you're doing research on what card type or what actual credit card might be best for you, NerdWallet is a really great place to do that research. If you haven't heard of NerdWallet before, they are an educational resource for all things financial. They offer education and information in all realms of personal finance, from building credit to taking loans to paying back debt to investing. And one thing that I personally love about NerdWallet is that they do ratings and give transparent reviews on different financial accounts that are out there. So Aiden dropped a link in the chat. That's what I was checking to NerdWallet. Like I said, they offer really great reviews. So as you're looking at different cards, you can use NerdWallet as a tool to see what they have to say about the card. And we'll talk about different things throughout this webinar, like fees and interest. But NerdWallet does a really good job at collecting all of that information and putting it in one place for you as you're doing the research. All right, so moving on to the cost of having or getting a credit card. The thing I think that we tend to focus on when it comes to the cost of a credit card is typically the APR or the annual percentage rate, um, or interest. These all generally mean the same thing. So APR, you can just think of interest. This percentage rate represents the annual cost of borrowing money, including fees for credit cards. It is important to note that credit card companies won't charge interest on your purchases if you always pay your entire outstanding balance by the payment due date. However, if you do carry a balance, each purchase will usually begin accruing interest on the day the transaction is made and added to your outstanding balance at the end of each billing period. So, with that said, your APR doesn't actually matter that much if you commit to paying your balance in full each month. And a little bit later, we're going to kind of really unpack when interest gets charged and how the grace period works, because I think that can be something that um, can be confusing and kind of tough to wrap your head around. For now, let's just walk through a quick calculation to help you decipher how interest is calculated and like how much interest is calculated. So let's say this is for someone with an outstanding balance on their credit card of $5,000 and they've also got a 22% interest rate. So the first thing we're going to do here is determine your daily periodic interest rate by dividing the APR of 22% by 365 days. That gives us the percentage you see on the screen here. It's a very small percentage. We'll take what we got there, multiply it by 30 days because there are 30 days in a typical month. And then we'll also multiply that by the outstanding balance, which in this example is $5,000. So if this was you with a $5,000 balance and a 22% interest rate, you'd be paying about $90 a month for this debt. And that's a lot of money, right? Carrying a balance on your credit card can definitely be a slippery slope. But along with interest, fees are the other costs that you could incur with a credit card. Annual fees, late payment fees, additional card fees, balance transfer fees, cash advance fees, foreign transaction fees, credit limit increase fees, and returned payment fees are all examples of fees that you could incur with your credit card. It is important to be aware of what fees a credit card account will charge you before signing up for the card. NerdWallet does help with transparency around these fees, so that's part of the reason why I think it's such a great place to do research. They will straight up tell you, here are the fees that this credit card account charges. So knowledge is power, right? Moving on to credit card perks. Along with building our credit score, I think another thing that most of us tend to be looking for when we sign up for a credit card is some sort of perk, right? Whether that be points, travel miles, cash back. We want to get something from our credit cards, right? I will highlight though that if you get a credit card and go into credit card debt, so maybe you end up being that person on the last slide with the $5,000 credit card balance, you're likely paying the bank more in the form of interest charges than you'll ever see in the form of cashback or other perks. Remember at the beginning when I said banks offer us credit cards to make a profit? Got to think about that. For every person who uses their credit card responsibly and receives these perks without incurring interest charges, there are probably 2 or more people out there who are paying the bank much more in the form of interest. So we just got to keep that in mind. Not every person is a credit card person, and that is okay. Anywho, when it comes to perks, we've got points. Points can typically be redeemed for cash back, merchandise, gift cards, travel, and even fun events like concert tickets or sporting event tickets. You can get travel miles with travel cards, which can usually be redeemed for flight credit or other travel-related expenses. And I think the most common credit card perk is cashback. Typically, you can redeem cash back for statement credit or opt for the company to just cut you a check with your cash back. And then you can use that on whatever you choose. Personally, I was just telling a colleague in my office this morning. Personally, I use my monthly cash back to cover the cost of my monthly gym membership. And I love the fact that being a responsible credit card user actually pays for my gym membership every month. And on the last slide, we talked about annual fees, right? That's an example of a fee that a credit card could charge you to have and maintain that account. Cards with annual fees usually provide better or higher reward structures than cards without annual fees. With that said, before you go and get a card with an annual fee to take advantage of those perks, you should do the research and the calculations to be sure that the rewards that you are getting are at least equal to or higher than what you're going to pay for that fee on an annual basis. Otherwise, you are back to giving the bank a profit, right? So you've done your research and you're ready to apply. What should you do to prepare, and what information do you need to have to apply? First things first, you should check your credit score. This can help give you an idea of which cards you'll be eligible for, or if you might need to look into a secured credit card. You can check your credit score for free at creditkarma.com. And if you want or need to work on improving your credit score before getting a credit card, you could do that. If that's you, I highly suggest watching our last recorded webinar on credit. It's actually called All About Credit. We have that recorded on our YouTube channel, and we'll drop a link in the chat. So when you're ready to apply, you want to gather a few important things: your social security number, your income information, and also your debt information. You'll also need to provide your address. When you are ready to apply, you'll visit the company's website, call them, or visit a local branch in person. If you're going with a big bank like Chase or Bank of America or Discover, usually using their website is the best way to go. From there, you will click apply and submit your application. Of course, if you are in person, you'll submit the paper application in person. Oftentimes, if you do this online, you'll be approved or denied instantly, so you actually will know right then. If you are approved, congrats, you'll get your card in the mail at the address you provided on your application in 5 to 7 business days. And if you are denied, the lender is actually required to supply you with an adverse action notice explaining why you were denied and which credit report was pulled. So they'll give you something to kind of work on there and work towards. Okay, so once you've got your credit card, here are some steps that you should take. First, set up your online account and app. You will be able to view your transactions and make your payments here. Next, you want to pay attention to and understand your grace period. A credit card grace period is the time window between the end of a billing cycle and the payment due date. If you pay your full balance by the end of your grace period, you won't get charged interest on the new purchases that you made during that time. Grace periods are usually at least 21 days. So, for example, if your billing statement was issued on October 31st and the payment due indicated on that billing statement is November 22nd, the grace period is the time between those dates. A billing statement issued on October 31st would contain spending that you did during the month of October. So if you think about that, you don't have to pay that back until mid-November, right? So that's kind of a while. And as long as you pay it back in full during that time, you won't be charged interest. But some credit cards don't have grace periods, so it is important to look at your terms. Most of them do. And personally, I don't think I would take out a credit card without a grace period because they would pretty much start charging you interest immediately. When you do get your billing statement, you'll see all of the transactions that you made during that statement period. So they'll all be listed out for you there. You can see everything that you spent your money on. And you'll also see on that list any payments that you made during that time. On the top or towards the top of your billing statement, you'll see your current balance, and you'll also see a minimum payment due. Usually, this minimum payment is calculated as a small percentage of your overall credit card balance, often 1 to 4% or $25, whichever is higher. So, for example, if you spent $500 during your billing cycle and made no payments, $500 would show up as your current balance. And then you'd likely see a minimum payment due of $25. Paying that $25 payment will keep your account in good standing. But if you only make that $25 payment or the minimum payment due, the additional $475 would begin accruing interest after that grace period is over. This whole thing can be kind of tricky to wrap your head around, so I hope that makes sense. I'll look for more questions about this at the end, but that's kind of a crash course on, you get your statement. That statement has got a total balance due and a minimum payment due. If you pay that total balance due before, oh my gosh, I'm sorry. If you pay that total balance before the due date, you won't be charged interest. If you make that minimum payment or even minimum payment and maybe some additional, but not your total balance, then you'll be charged interest on whatever's left over after that grace period has ended. Okay. This is kind of a shorter webinar content-wise. So we've got lots of time for questions. And also before we kind of wrap up our official content here, I wanted to kind of play a little game in the chat and just go through some credit card myths. I would love to hear what you guys think of these, if they're true or false, and then we'll kind of unpack them and talk about them all together. So let me pull up the chat here. So I've got it handy and I can look at it. So I'll just read out a credit card myth, and then if you guys want to chat, if you think it's true or false, and then we'll talk about it. I've got, okay. I will address the question about minimum statement balance. Let's wait for that at the end. First, credit card myths. I've got 4 of them. Number 1, it is a good idea to accept or sign up for credit card offers that come to you in the mail. Do you guys think that's true or false? Seeing some falses. I would agree. That one is false. Again, I was just talking about this with a colleague recently. And this all just comes back to the fact that the banks have something to gain, right? So they're seeking you out because they want to earn a profit from you, right? Whereas if we are doing our own research and only applying for credit cards that we are seeking out ourselves, that oftentimes is going to make the most sense and is going to serve us. So if you are getting credit card offers in the mail, don't feel like you need to apply for those. don't even feel like it's a good idea to apply for those. Okay. Myth or truth number 2. Carrying a balance helps boost your credit score faster. Thanks, Aiden. Yeah, just because it's offered to you does not make it good for you. And that's true with a lot of things, right? So carrying a balance on your credit card helps boost your credit score faster. Is this a myth? Or I'm sorry, I don't want to be confusing. Is this true or false? I'm not seeing anything come through, so I'll do the myth busting for you. This one is false. Carrying a balance on your credit card does not boost your credit score. It only costs you money. So don't feel like you need to do that either. Number 3, and remember we've got 4, so this is 3 of 4. Experts suggest having no more than 3 credit cards. Do we think that's true or false? I see some trues flying in. Um, so this one's kind of a trick question. There's no like hard and fast rule out there for how many credit cards that you should have. It's a good idea to not have more credit cards than you like need or use. But based on the research that I've done and what I've seen released by the Consumer Finance Protection Bureau and like FICO score information, to keep your score good, the credit industry suggests having 5 accounts total. And that's not just credit cards, that's over all different types of loan accounts and credit accounts. So to meet your 5 accounts, that could look like having 3 student loans, a credit card, and a mortgage. But again, with that being said, don't run out and open up 5 credit cards just so you can meet that limit. Oftentimes, you'll just open credit cards kind of organically, and you should never really go out and open multiple at once. Aiden said it well in the chat. Managing the cards that you have well is greater and better than the number of cards that you have. Awesome. And then last but not least, our 4th truth or myth is keeping your total balance under 30% of your credit limit is good for your credit score. Keeping your total balance under 30% of your credit limit is good for your credit score. Yes, so that is true. And that's something that I think we don't think about or like talk about enough. So let me unpack that a little bit. Keeping your total credit card balance at all times under 30% of your credit limit, even if you pay off your balance in full and on time every single month, keeping that balance under 30% does boost your credit score. So, for example, if you've got a credit card with a $1,000 credit limit, to follow this rule and keep in line with this, you would want to keep your balance on that credit card at any given time, even if you do pay it off in full every month, under $300. That's kind of how that works in a nutshell. Do we have any follow-up questions from our truths or myths here? Not sure if I said this piece, but to really embody being a responsible credit card user and um, kind of see how it's affecting you and your overall credit score, it's a good idea to monitor your credit score after you've gotten that first credit card and see how it affects your score after a few months of responsible use. Credit Karma, again, is a great tool for checking and monitoring your credit score. It's a free tool and it doesn't hurt your credit to check it on something like Credit Karma. Or your new credit card might provide you with your credit score or your FICO score for free each month. I know that mine does, and I always get excited when I see that email come through, like your credit score this month is ready. And it always is fun to check it out. So we'll dive into questions here in just a minute. I'll look back through the chat and answer any questions that have come through there. But it is also important for you to know that we are here to help. We have a lot of different services and resources that are available to Penn State students, and some of our services are even available to staff and faculty and the larger Penn State community. And our goal with all of these programs is really to help you understand and take control of your finances. So if you are thinking about getting that first credit card or having trouble managing some of your credit cards and need some further individualized guidance, we are here to help. We do offer one-on-one financial coaching appointments. Those are primarily for current students. Current students can schedule those in Starfish. We work with alumni as well. If any alumni out there are interested in meeting with us one-on-one, you can email us at finlit@psu.edu to get something set up. We specifically don't offer one-on-one appointments to Penn State faculty and staff. We just don't have the capacity for that right now, but we do work with our partners at PNC to offer those to our faculty and staff and do kind of the same work that we do. So if you're someone who feels like that could be helpful and you are a Penn State faculty or staff member, just email us again at finlit@psu.edu and we'll get you connected to someone over at PNC. We've also got our group presentations and webinars, and those can be scheduled for classes, student organizations and groups, and also intramural sports. We've got our self-study modules on a variety of different topics in Canvas, and those are open to the public. If you want to dive in a little bit more, but you're not maybe quite ready to sit down with someone and talk through it one-on-one, go ahead and check out our credit card self-study module. Our mentoring program is another service that we offer, and this kind of provides a space for current students to connect with alumni or someone in the Penn State community to receive guidance on not only their finances, but also these important life skills. And last but not least, we've got our workshops. This is one of our newer offerings at the center. And this is an opportunity to get hands-on with your finances. We call them our financial foundations workshops. So within these workshops, instead of learning about budgeting, you'll, build and physically work on your own budget. Instead of learning about your credit score, you'll pull your credit score and look at your own credit report. These are actually happening right now for the fall. But if you're interested in that, keep an eye out on our website because we will be offering those probably again in the spring. So that is all we had for you today. Here's our contact information. If you'd like to give us some feedback on today's webinar, we would definitely appreciate it. You can scan the QR code here and we'll also drop a link in the chat to that survey.